Hello, and welcome to the short video in which I'm going to have a look at the difference between really a director paying himself a small salary and dividends versus paying just a big salary. It's obviously a complicated calculation because the tax rates are very different. And if you're a one-man band, you need to consider the corporation tax as well as the tax on salary. So the best way, I think, to explain it or to compare it is to really look at the overall position between the company and the director. What's the total tax payable? But let's have a look at an example. So in this example, I'm going to focus on a director pay himself a salary of £50,000 for the year. So here, if the director pays himself £50,000 salary, then that will be the PAYE tax. That will be the employee national insurance, which means he will clear £39,000. There's also going to be £5,644 employer national insurance payable. So really, if you look at it from the company's perspective, the company needs to have £55,644 turnover, less the employer national insurance, less the gross salary is what it can deduct as expenses, which means that will give it a net zero profit position. So no corporation tax due in this example. So director will clear 39,521. And here at the bottom, I've just made a summary of the total taxes payable in this example, which will be employer national insurance, PAYE tax, and employee national insurance, which gives you a total of 16,123. Now let's have a look what it will look like if you pay a small salary and dividends, but the main focus here is to try and see where you need to clear the same amount as with a salary. So in a company, interestingly enough, you only need to do £53,045 turnover. The director will pay him a small salary of £9,096 per year. With that salary, even though no national insurance is payable or no PAYE tax, the director will still qualify for the state second pension fund. So in this example, the company will have that turnover less the gross salary as an expense, which gives you this profit before tax. In this example, I'm just going to use 25% for corporation tax. Obviously, if it's a business now who's got £50,000 and less turnover with no associated companies, then that corporation tax is only going to be 19%. To make this simple, let's just use the main rate, which is 25%. So profit before tax less the corporation tax gives you profit after corporation tax. That is what you can pay out as dividends. So if you pay that out as dividends, the director will clear that dividends plus the net director salary. But he's also going to pay tax on those dividends. So when he does his own personal tax return. So let's deduct that. So this is the total the director will clear. So basically that's what the calculation will look like from the company's perspective. And here at the bottom, I've added up the tax the director's going to pay plus the corporation tax, which gives you a total taxes payable of 13,523, which is slightly better than the 16,123 if you pay a bigger salary. This is mainly the reason why most directors would pay themselves a small salary and dividends. It's also important to note there is a bit of a cash flow advantage as well, because the corporation tax is only payable 9 months after the company year end. And this personal tax is only payable when you do your personal tax return. Whereas if you pay yourself a bigger salary, you've got to pay the P1NI on a monthly basis, not on the 19th after the month that you've submitted the salary. What I've done is I've done another calculation here just to compare the company and earning the same amount, because remember in this example, the company actually had to produce less income to clear the same amount. So what will the example look like if the company just had the same turnover? What can it pay its director? So this calculation is going to be, this is exactly the same for the salary, but here we're going to have salary. This is going to, because the turnover is more, it's going to create slightly higher profit before tax. The corporation tax is going to be slightly higher, which means there's more profits to pay out as a dividend. The dividend tax is also going to be slightly more. If you then the director in this example will be able to clear 41,344. So actually, what is that difference? So there is a difference there of £1,823 that he will clear more with the same turnover now. And if you look at the bottom here, you will see the tax paid through the company is 14,300. Salary is still 16,123, and that gives you that 1,823 difference that I was referring to. So I hope you find this helpful. If you want to hit the comments or just share in the comments below if there's any other calculations or examples that you would like to see to try and understand all of this, then please do that. Thank you so much for listening, and I really hope that was helpful. Thank you.